Hello bro and welcome back to the new stock evaluation. So today we are going to analyze this extremely famous company called McDonald's Corporation with the stock ticker MCD. And because they actually recently launched their new McDonald's menu or whatever for $5, which is something that you probably have in America, but we in Europe for sure don't have it, or at least I doubt that we have it, okay? Now, but let's leave that aside. Today we are going to analyze this using our little Canva presentation that we always use for all the stocks analyses, okay? Now, before we begin, why should you even listen to me? My name is Yasha and I am your best investment advisor who will help you make smart decisions with investments. Now, this is me right now here. And additionally, when you will trust me a bit more, you can go to the first link in the description to download my full PDF guide how to use some strategies to outperform the SP 500. Now let's begin with the analysis. This is going to be very beginner friendly, quickly analysis. I don't want to waste your time too much, so let's begin, okay? So first of all, as a complete beginner, you should care about the following 6 things: chart, profit, debt, money on the bank account, value, and price. Now you already probably know McDonald's. This is a fast food restaurant founded in 1940. It has like worldwide recognition and you also probably eat here. So you know what we are going to do, okay? Now, in terms of the chart, this is the first step towards the analysis. We have a little instruction that tells us chart has to grow for all 10 years. Now, what exactly does that mean? That means that first of all, I will draw a little exponential growth line, kind of like this. And then we are going to compare the actual stock price chart, which is this orange line, with that black line, because we want to see that the orange line follows that black line, because that basically tells us that the company is growing through the years exponentially, okay? Now you can see here that that both lines are actually following each other. The actual stock price is nicely following this line, of course, with ups and downs, but generally, the stock price is the stock price chart, let's say, is a good thing, okay? Now we come to the profit, and for profit we also have an instruction that profit has to be in plus and it has to grow. Now here is the very same story, bro. We are going to draw that exponential growth line, kind of like this, and then we are going to compare the profit with this line. And you can see, bro, that the profit also in this case follows the line. It grows exponentially, of course, with ups and downs, but it goes towards the top. So this is what we want to see as well, okay? And now we come to the debt, and instruction tells us that debt has to be low and preferably it should also decrease through the years. Now what do we have here? Here we have exactly the opposite. The debt is growing. However, in the recent years, it's kind of being on the same level, which is maybe a good sign, bro, because they are not increasing the debt, but increasing the income. So maybe they are using this debt for more reinvestments and so on to basically expand the company. But generally, the debt is growing, which is what we don't want to see. Now we come to the money, and for the money, we mean money on their literal bank account. That's the money that they can withdraw at any time whatsoever when they go to a local bank, and then they say, just like you go and you say, yeah, give me 100 euros. This is how they go to the bank, and this is basically the money that they have, okay? Now, preferably, they would have to have more money than costs so that they can potentially cover some unexpected events that might happen, because unexpected events are fucking unexpected, so you don't know when they happen, how bad they're going to be, how long they will last, and so on. So it's important to have more money than costs. Now, do they have more money than costs? Bro, use your brain. Look, here they have $7.2 billion on their bank account. So clearly here is a plus, so they clearly have more money than costs, okay? More money than costs, which is what we want to see. Now we come to the value, and we obviously want to buy stocks that are undervalued with a potential to grow even more. Now, how do we analyze overvalue? So how do we analyze valuation? Okay, we analyze it by using so-called P/E ratio and so-called intrinsic value. Okay, Now, as a complete beginner, those concepts might sound a bit complicated for you, but you should only keep in mind, bro, that P/E ratio should be lower than 15 and intrinsic value should be higher than the current stock price. Now, you can find both of those data on the internet. You literally go to Google and write McDonald's Corporation P/E ratio and McDonald's Corporation intrinsic value and you get the numbers. It's that simple. Now, let's go to the P/E ratio. Okay, P/E ratio of McDonald's is currently 21, which is slightly higher than 15, what we want to see. So in this case, we are going to mark this as an overvalued metric, okay? And now we come to the intrinsic value, and here I want to have your full attention because this is quite important and yet a bit complicated concept for beginners, okay? Now, intrinsic value, bro, tells you the actual value that this company should have at this exact moment. You know what I mean? So the analysts and those complicated calculations are calculating all the data from income statement, balance sheet, and cash flow statement, and they come up with that number based on those calculations, okay? So right now, the fair price based on income, based on debt, based on the price on whatever, should be almost $200, okay? So $199 should be the fair price of McDonald's at this exact moment. The McDonald's should be priced at this price right now here, almost 200. But the actual price, bro, is around $250, which is $50 more than it should have been. In that case, bro, this stock is also overvalued in terms of the intrinsic value. You know what I mean? Basically, intrinsic value is what the company should have and price is what it currently has. You know what I mean? So the stock in that case, bro, is overvalued. And now we come to the price, and for price, instruction tells us that price has to be lower than 150 euros or dollars in this case, okay? Because this is a number that I came up with myself. So $150 is currently the border between overpriced or underpriced stock. I know that in my personal case, I wouldn't pay for stock more than 150 euros because then I don't get any profit from it whatsoever, okay? And the current price of McDonald's is around $255, let's say, which is for 100 euros or dollars higher than what we want to have. So this is, and I know the green one. So this is, fuck, I don't know what's with my mouse, bro. So this is not a good thing to see, okay? Because it's 100 euros higher than our upper border, you know what I mean? And now we come to the final evaluation, bro, where we are just going to summarize everything that we found out about McDonald's so far, okay? So in terms of the chart, bro, chart is really impressive. It's growing through the years, which is what we want to see. Profit as well, bro, it's growing exponentially, just like the chart, so that's a good thing. Debt is also unfortunately growing, so this is not a good thing. Now in terms of the money, they have, I think, like $7 billion. Let me see again, please. Yeah, $7 billion, so that's a good thing. In terms of the value, bro, McDonald's is overvalued, so that's a bad thing. And it's also overpriced by $100, so that's also not a bad thing. I mean, that's also not a good thing. And now we come to the final decision, bro. Should we buy or sell? We should fucking sell. Now you might be a bit surprised right now. Why should we sell if we have growing chart and growing profit? And here I want to show you my Excel table that I use for in-depth evaluation. And here I want to show you total equities. Now total equities mean all the money that company gets inside, okay? So literally everything, the rent, the burgers, the profits, the whatever, all the money, literally all the money coming into the company, okay? And here you can see that they are in minus for the last, how much, like 7 years. Bro, that's way too much. What does that mean, bro? If this is here in minus, that means that they have more costs than money, even though their money on the bank account is in plus, but they are still making loss. Look, return on equity is basically how much money you get, you know, based on your operations, based on your investments, whatever, okay? And here they have minus almost 200%. That's way too much, bro, way too much. And look also here, bro, debt to equity shows you how much money does the company get in comparison to the debt, okay? Now, if this is in minus, that means that they have higher debt than they have money coming inside, which means debt is higher than profit. And that's completely unsustainable, bro. That's why I wouldn't touch this stock, in my personal opinion. I wouldn't touch McDonald's. It's even bad for your health, bro. So it's bad for your finances, it's bad for your portfolio, and it's bad for your health, bro. They are going slowly broker and broker, bro. They are fucking broke. They have minus income, they have too much debt. So no, in my personal opinion, I wouldn't buy it. If you want to know more about stock market investing, bro, of course, you can click subscribe, join me on this amazing journey to get rich as quick as possible. Click the first link in the description if you want to know more about secrets of stock market investing. Do the hard work and see you on top of the world.